Welcome to Stock Talk with Nico Criticos. Today we're going to do some stock analysis for Texas Roadhouse, ticker TXRH. So this is not a stock that I own, but it's a stock that I want to own if the price is right. So in the last 5 years, the stock's up 70%. This year it's had an excellent run. It's up 25%. And the market cap on this company is about $7.2 billion. If you don't know, Texas Roadhouse, full service, casual dining restaurant chain that they're famous for their steaks, but they got everything else: cheeseburgers, sandwiches, salads, pretty much anything that you want. It's normally very busy there. And if we take a look at how popular this restaurant is among other chains, we're going to see that on this list, they rank number 24. And on this list, they rank number 20. And then on this list, they rank number 3. But I think the reason they rank much higher on this list is because the first two lists include more fast food places like McDonald's and stuff, and this is for more sit-down restaurants. The other thing I found out while reading this was that they actually have locations across over 10 countries, including Kuwait, Philippines, and China. I was not expecting that, but that's an interesting part of their business. So if we look at their revenue and net income, we're going to see they grow revenue at about 12% per year, which is very strong. And they did $4 billion of revenue last year. Net income is growing a little bit faster at about 15% per year. And they did $269 million of net income last year. Those two things look good to me. Then we're going to check out its PE ratio, which is one of the only concerns for me. And you're going to see that historically, the stock will trade anywhere from a 14 all the way up to about a 30 PE ratio, right? So I would say somewhere around a 20 or a 21 is the average. Right now, it's trading at a forward PE ratio of 23 based off of what they will do for this year's earnings. So sitting at a 23 is somewhere in the middle. Definitely, I mean, it's not super cheap and it's not super expensive. So this honestly might not be a bad price to buy in at, but I'm just expecting it to fall maybe to about $90 a share, then I'll start buying it. So that's how I feel about the PE ratio. Then if we get to the innovation factor, if they have a moat, I put no, I don't really see it there. The industry is growing. I was surprised it's actually growing at 11% per year, which is a lot more than I thought as far as sit-down restaurants. And then the return on invested capital is sitting at about 17%. 17% is very good. So that's going to get a check. Then we're going to look at its equity. And the equity here is growing, but not by a lot. It's pretty slow, as you're going to see. And the other thing I like to look out for is the goodwill. So you have to make sure that there's not too much goodwill on the balance sheet or intangibles. And that's what we're going to see here is they do have a little bit that went from 120 million to 150 million. But overall, the equity has gone from 900 million to a little bit over $1 billion in the last 3 years. So not bad. That will get a check. Then we're going to look at, unfortunately, number 8. I had to give this a no. It barely missed, but it still is a miss only because I'm taking out goodwill. If you include goodwill, it is 15% of the market cap. But when you take it out, it's less than 15%. So I just like doing that because I don't like counting goodwill and intangibles that's not a strong asset. It's not a liquid asset. It's something, it's tangible. If we look at the share count, we're going to see that it is decreasing, but not by a lot, not more than 1% or so. And then we're going to look at the balance sheet to see if they have 2x the assets and liabilities, and it's close. They're almost there, but not yet. So that's going to get a no. Then is the profit margin over 10%? Well, unfortunately, it's not. The profit margin is about 7%. So not bad. I mean, I know restaurants are a thin margin, small margin business anyways. So that's to be expected. 7% is not horrible. And this is something that I always like to see. Their cash and receivables are more than their average annual income. They have about, I think, 300 million or so, a little bit over 300 million in cash and receivables. And their income is normally somewhere around that $250 million, $270 million point. So that's going to get a check. The dividend is also pretty healthy. Not a huge dividend. It's only 2% at the moment, but I mean, since the stock keeps going up and up, it's probably harder to get a large dividend yield on this. But the payout ratio is what is important. It's only 46%. That's healthy. And I like to see if they're growing the dividend. 17% dividend growth each and every year, pretty much. That is pretty outstanding compared to most other companies that I look at. So that's good. And the company is over 20 years old, founded in 1993. So overall, we're looking at a score of about a 10 out of 14. Really just missing those 4 things of not too innovative. They don't really have a moat. I can see other people going to, I mean, I guess the one important thing on this about these lists is that, so you see all these other restaurants that rank in front of it. Buffalo Wild Wings, Applebee's, Olive Garden. Those are like a little bit more of dine-in, sit-down restaurants. The other ones are more so just fast food like Arby's and Panda Express. But those other ones aren't really, Texas Roadhouse is the main place you go for like a steak. These other places, they don't have steaks like that. So that's what I feel, if anything is their moat, it's that they're famous for their steaks. You know, you can go to Longhorn Steakhouse, but that ranks way higher, right? There is other steakhouses, but not that rank that high. I think every time I've gone to Texas Roadhouse a couple times this year, and it's busy every single time. It's kind of like, I feel like it's the same thing with Chick-fil-A. Chick-fil-A is always ranking high up. See, Chick-fil-A is number 3. And I think it has something to do with the scarcity mindset of like, when they're closed one day a week, that helps, I think. Or for Texas Roadhouse, they don't open till 3 p.m. in the afternoon, I think. So I think things like that is what creates that scarcity. And as soon as 3 p.m., 4 p.m. rolls around, Texas Roadhouse starts getting busy, and it usually stays busy. So I think that's a place that people think of when they want a place to get a steak that's they can easily get in and out of. And so that would be the only thing I can think of for a moat. Their balance sheet is not bad. It's really not bad. They missed on a couple things here, like the equity and stuff, but it's a slight miss. It's a slight miss. So they don't have a fantastic balance sheet, but it's good. It's not bad enough. It's not too bad. Then the profit margin is only 7%. That's something where it's like, if you look at similar restaurants, let's look at what is Olive Garden profit margin. Olive Garden profit margin is 9%. So it's actually, well, that's for Darden Restaurants, which owns multiple different chains. So, okay, so maybe 7% is still on the weaker side of things then. But overall, they have a lot going for them. I think there's a lot of positive things to see in the fundamentals here. So that's why this is definitely a stock I would consider buying if the valuation was cheap enough. So that's all I have for Texas Roadhouse. Thank you for watching, and I will see you guys in the next video.